Hi, today I will be presenting a fundamental analysis on my assigned company, Cinemas Land Limited. The fundamental analysis will be performed using a top-down approach which covers the economy, industry, and down to the individual company information. The purpose of this study is to make an informed decision through the stock value and growth potential. Starting with a brief introduction of Cinemas Land Limited, it is originated from an Indonesian group Cinemas and listed on SGX since 1997. It is engaged in the property industry as can be inferred from its name. Cinemas Land Limited invests, provide property development and leasing for commercial buildings, hotel resorts and other kinds of properties. Although its investments are mainly in Indonesia, it also has operations in Singapore and other countries. The first step in the top-down approach will be the overall evaluation on the financial health of the general economy. As when economy expands, most industries and businesses benefit and growth and vice versa. Economic analysis can be performed using economic indicators, and today I will be touching on three of the important ones: interest, inflation, and currency rates. So firstly, for interest rates, this is the graph of the current and predicted Singapore interest rates. As seen from the graph, interest rates are expected to grow throughout the years to a high 4% in 2030. Interest rates can impact the company business as individuals would be affected through an increased expenditure in interest items such as credit cards and thus spend less, resulting in lower business revenue and profits. Similarly, as banks would make borrowing more expensive and businesses to pay higher interest rates on their loans. Interest rates would also affect the company stock price. As mentioned, an increase in interest rates would affect the company business profits through the higher debt expenses and lesser revenue from consumers. This would result in a lower estimated future cash flow and affect the company stock price as evident from one of the stock price valuation, the discount cash flow model. Lastly, interest rates would also affect investments as lower expectations in growth would make stock ownership undesirable. And as interest rates goes up, the total return required for investing in stocks also increases, which should in turn be viewed as more risky to investors and thus affect investment. The third economic indicator, the inflation rate. This graph shows the relation between inflation and interest rates, which both are predicted to increase together. In fact, inflation rates have the ability to influence interest rates and could indirectly cause the mentioned impacts on interest rates to occur. Moving on to currency rates, Singapore currency rates are also expected to grow throughout years. Similarly, currency can affect the company business and its stock price. Economies across the globe has become increasingly interconnected that company deals with currency in their business transaction, whereby they take and convert different currencies when they conduct their operations such as productions or manufacturing. This impacts their profit and loss. As Cinemas is originated from Indonesia and have operations across the world, these all would relate to each individual country currency rates and have an impact on the company business operations and in turn its stock price. The second step of the top-down approach would be the industry analysis. It is good to proceed to the industry analysis after economic analysis, as not all industries will be affected by the economy equally, nor at the same time in the business cycle. As mentioned, Cinemas Land Limited is under the property sector. I will be using the Michael Porter model for industry analysis, which would help to analyze the structure of Singapore property industry through the threat of new entrants and substitutes, bargaining power of suppliers and buyers, and last but not least, the intensity of rivalry among existing firms in the property industry. It will also help to determine the success rates and profit potential of the industry. The threat of new entrants measures how easy for new companies to enter the industry. Due to the existing of strong competitors such as Singapore Land and CapitaLand, etc., who provide difficulties for new entrants to enter, as it will be harder for them to create product feature difference to overcome the customer loyalty of the existing firms. Capital requirements will also be far out of reach for new entrants as they have to compete with the rich existing firms, incur marketing and R&D costs to create product differentiation, as well as other fixed costs like rental. In order to set up a property management company, a license has to be obtained from Singapore CEA. The government regulations are probably not as tight as in 2012. About 1,500 real estate agencies are licensed, which shows a relatively low barrier of entry. Although it is hard for new entrants to enter due to the capital requirements, but the license to obtain is not subject to any hard specific standards. So long as any company with large capital can actually find it easy to enter the industry. Thus, personally, I would classify the threat of new entrants as medium risk. The bargaining power of suppliers helps to measure how powerful they are. In the case of property industry, the government or in some cases the property owners are the suppliers who offer the land. The supplies are either controlled by the government or a small group of rich owners, as who can easily own property or land. So it normally revolves around the same group of people. And due to Singapore's small area, the land and property is also limited. Thus, personally, I will classify the bargaining power of suppliers as high risk. Similarly, the bargaining power of buyers helps to measure how powerful they are. The buyers will probably be the home or shop owners who are interested to acquire units of the properties. The demand of the property in Singapore is high, especially with the increasing population of locals and foreigners. And as property includes commercial property and hotel resorts, it is also targeted to shop owners, which increase the volume of buyers. Different types of properties allow customers to make a choice in terms of location, recreational facilities, price, and more, whereby it creates a differentiated product. With a high volume of customers and existence of differentiated products, make it harder for buyers to switch to competitors' companies expecting to find the same expectations. Thus, they would not give a second thought in switching companies. And thus, personally, I will classify the bargaining power of buyers as low risk. The threat of substitutes also play a part in determining the competition of the industry. However, in the property industry, there are typically no substitutes for property, as everybody needs a home, and for some, need it for work. Thus, personally, I will classify the threat of substitutes as low risk. Last but not least, the rivalry among existing firms. There are quite a number of existing firms in the industry, with some very strong ones. Together with the high exit barriers due to the harder comfortability to convert the assets, firms would find it hard to leave the industry and result in a more intense rivalry. Personally, together with the other four factors, I would classify the intensity of the whole property industry as medium risk. The last step in top-down approach is the company analysis, to evaluate the company resources and capabilities, which would cover both the business management and financial analysis. In my case, I'll be using SWOT analysis and financial ratios respectively. The SWOT analysis helps to break down the company's strengths, weaknesses, opportunities, and threats together with the help of internal and external environment. The strength of Cinemas Land Limited would be its strong backing from Cinemas Group and Land, whereby Cinemas Land is one of its group sector companies, with the long stretch of experience in the property business, strong partners, and plenty of awards, which all these can help Cinemas Land Limited Singapore. Although with its strong backings, it is after all established and strong in its home country, Indonesia. As seen from the data, most of its revenue come from Indonesia, followed by China, Malaysia, and UK, with Singapore revenue the least. This would probably show that Cinemas Land Limited focus on overseas market more, and furthermore, it has a relatively weak brand name in Singapore. Opportunities can come in the form of industry prospects, as mentioned earlier in the industry analysis, by taking advantage of the high demand in the property market in Singapore. And as Cinemas Land Limited deal with operations in other countries like China and Malaysia, it can actually diversify its property portfolio management. As mentioned, there are a number of numerous and capable property companies here in Singapore, which will pose a dangerous threat to Cinemas Land Limited. Together with Singapore Small Land, who also pose a threat due to a limited property to be built. Another part to analyze the company capabilities would be through its financial ratios. throughout the years and with its competitors. I will touch on the profitability, liquidity, and valuation ratio for Cinemas Land Limited. Starting with the profitability ratios, the profit margins show the percentage of each sales dollars earned as net profit. A 25% in 2013 means that for every $1 net sales generate 25 cents of profit. An increase from 2012 show better cost controlling. Next, the return on equity measures the relationship between net profit and shareholder investment in the company. The 2013 ROE for Cinemas Land Limited has increased more than twice of 2012 ROE. This shows that the company is more efficient in using investment funds to generate earnings growth. Although the profitability ratios in 2013 is an improvement from 2012, but we have to also take note of the future trends. And as obtained from Bloomberg, the profitability ratios in 2014 and 2015 are predicted to drop. By comparing its ROE to its competitors, Hobby Land Limited and Singapore Land Limited, Cinemas Land is not as efficient in using investment funds to generate earning growth. Moving on to the liquidity ratios, the quick ratio measures the company's ability to pay its debt at a very short notice. A ratio of 1.21 in 2013, a 4-year low, indicates that each dollar of short-term debt is backed by 1.21 of cash or near cash assets. As for the debt ratio, it also tells us the percentage of assets financed by debt. The higher the assets financed by creditors, the riskier the company. Compared to its competitors, Cinemas Land Limited is considered more risky because of a higher debt ratio. Lastly, for valuation ratios, PE ratios show the relation of the share market price to the company earnings. A decrease of PE ratio in 2013 indicates that investors are not willing to pay more to buy the shares, which may also think that it do not have a good prospects. From the top-down approach, I can actually determine if Cinemas Land Limited is worth investing. Firstly, from the economic analysis, I can conclude that the economy is going to be worse throughout the next few years. However, as an investor, I can't possibly stop investing in everything just because of the bad economy. So we have to move on to the conclusion of industry analysis to determine if the property industry is worth investing, as not all industry will be affected equally or at the same time in the business cycle. In the industry analysis, I can conclude that the competition is relatively high because of the existence of strong competitors, but at the same time, property demand is high. The property industry trends has been rising for the past 10 years. Together with the increasing populations and staff, there is no doubt that the property industry will keep doing well. Thus, property sector is absolutely a good investment. The next step is to determine whether Cinemas Land Limited is a worthy investment. From the SWOT analysis, it clearly shows that Cinemas Land Limited revenue mainly come from other countries and could be due to the limited effort put into the Singapore market. As for the financial ratios, the profits predicted for the next few years are likely to drop, and a higher debt ratio as compared with competitors makes Cinemas Land Limited stock more riskier to invest. Not forgetting the current valuations shows that investors are not willing to pay more to buy Cinemas share, which is probably associated to bad prospects. In conclusion, personally, I've decided not to invest in Cinemas Land Limited as there are better investment choices in the property industry, which has higher profits and less debts as compared to Cinemas Land Limited.